Hey everyone, and welcome back to the channel. For the past several days, something really interesting has been brewing just beneath the surface of the silver market. If you just glance at the price charts, things might seem a little quiet, maybe even a bit boring, especially with all the crazy geopolitical news we've been getting. But here's the thing, whenever you see prices stay flat while the fundamental conditions underneath are shifting dramatically, it's usually a sign that the market hasn't caught up to reality yet. Right now, silver is trading just under $90 an ounce. That's a little lower than yesterday, and gold has only pulled back a tiny bit. On its own, you might look at that and think, okay, this is just the market reacting to the latest tariff headlines and a stronger dollar. And you'd be partly right. But that's only the paper market, the world of futures and ETFs, reacting to macroeconomic signals. It doesn't tell us the full story about the physical metal itself, which is where things get really fascinating. What's making this moment so unique isn't one single news event or policy. It's the complex dance between trade policy, geography, and where the actual physical silver is stored. We often forget that silver isn't just a number on a screen. It's a real, tangible commodity. It has to be dug out of the ground, refined, shipped across oceans, stored in secure vaults, and eventually delivered to a buyer. And when the cost or the logistics of moving that metal change, the price you see on your screen can lag way behind the economic reality on the ground. Recently, we've seen new policies that are throwing a wrench into the works of the transatlantic trade flows. Tariffs have been announced on imports from several European countries, including the United Kingdom, and they're set to kick in within weeks, not months. Now, the initial tariff rate might seem modest, but it comes with a catch, a clause that allows it to escalate later this year if negotiations don't go as planned. From a market structure point of view, this is a huge deal. Why? Because London and New York aren't just symbolic financial centers. They are the operational anchors for the entire global silver price. London is the world's main hub for physical, over-the-counter trading, while New York dominates price discovery through its futures contracts and the massive vaulting systems that support them. In a normal world, silver flows smoothly between these two cities. If there's a shortage in New York and a surplus in London, big players will buy it in London and ship it to New York to sell for a profit. This process is called arbitrage, and it's what keeps global prices relatively consistent. But here's the key. Arbitrage isn't free. It costs money for transportation, for insurance, for financing, and most importantly, it's affected by regulations and tariffs. When these costs get too high, the arbitrage trade breaks down. It's not that people don't want to do it anymore, it's that the economics just don't make sense. Suddenly, moving the metal costs more than the profit you could make. Introducing a new tariff is like raising the bar for this entire process. At a 10% rate on $90 silver, you're adding about $9 of cost to every single ounce. If the rate goes higher, that cost goes up too. This means that price differences between London and New York that would have previously triggered a flood of silver shipments might not be enough anymore. The markets will simply have to tolerate a much wider price gap between the two regions before any metal actually moves, if it moves at all. This creates a situation where the price in one location can become disconnected from the price in another. So what does this mean for the physical inventory? Well, the COMEX registered inventory in New York, which is the silver available for delivery against futures contracts, has been drawing down. At the same time, we're seeing this new tariff barrier being put up, making it more expensive to bring silver over from London, which holds the world's largest stockpile. Think about it like this. You have a dwindling pile of immediately available silver in one place, and the main pipeline to refill it is suddenly getting a lot more expensive to use. This isn't a theoretical problem for some distant future. It's happening right now. The market is structured in a way that relies on the free flow of metal, and that flow is being restricted. This creates a potential squeeze, not a dramatic overnight squeeze, but a slow, grinding one. The futures market in New York might continue to set a price based on paper contracts, but that price could become increasingly detached from the actual cost of getting your hands on physical silver, especially if you need it delivered in New York. The price for a contract might say $90, but the real, all-in, cost to buy silver in London and get it to a New York vault could be $99 or even more. When this happens, the system starts to show cracks. The people who sold those futures contracts, promising to deliver physical silver, might find it incredibly expensive or even impossible to source the metal they need to make good on their promises. This is the kind of underlying tension that doesn't show up in the daily price wiggles. It's a structural issue. We are entering a period where geography matters more than ever. The price of silver in London and the price of silver in New York could start to act like two different assets. An ounce of silver in a London vault is not the same as an ounce of silver in a COMEX vault if you can't move it between them economically. This isn't just about tariffs either. It's about the bigger picture of deglobalization and the fragmentation of global supply chains. For decades, we've operated under the assumption that goods and capital can move anywhere with minimal friction. That assumption is now being seriously challenged. And for a market like silver, which is both a financial asset and a critical industrial commodity, these frictions can have explosive consequences. So, as you watch the price of silver over the coming weeks and months, look beyond the daily headlines. Pay attention to the inventory levels in both London and New York. Watch the price spread between the two markets. These are the indicators that will tell you the real story. The quiet stability we're seeing on the surface might just be the calm before the storm, as the massive unseen pressures of physical market mechanics build up, waiting for the moment when they can no longer be ignored. The paper market can run on its own narrative for a while, but eventually it has to reconcile with physical reality. And right now, that reality is telling us that the cost and difficulty of moving silver across the Atlantic are changing in a fundamental way. It suggests that the true value of readily available, deliverable silver might be much higher than the current screen price lets on. This is a story that's still unfolding, and it's one that every serious investor should be watching very closely. Thanks for tuning in today. If you found this analysis helpful, be sure to hit that like button and subscribe for more deep dives into the commodity markets. Let me know your thoughts in the comments below. Until next time, stay sharp.